Okay, it's going.
Okay, hello, my name's David Peetz and
Georgina Murray.
we're coming to you live from South Bank in sunny Brisbane, Australia. Well, it's normally sunny, but not quite. And you're going to hear our talk about finance, capital and climate change, the role of climate-interested investors. And what we're researching is basically looking at the potential for... I hope you can edit this bit out. Well, I think it's not... We had it beautifully written, didn't we? It's basically, we're looking at the logic of finance capital. We're looking at the logic of finance capital, and is it possible within the logic finance of capital to have some groups, some subclass within finance capital that examine that can be focused towards the longer term, whereas the great drive in financialisation over the past few years, past 3 decades, has really been towards increasing emphasis on short-termism, which is detrimental to the planet.
Whether this is actually possible, whether it's possible in finance capital to have a situation where you have a long-termist perspective, which is a bit uncertain in terms of our research, which really shows there's dynamics of concentration and centralisation, which will ultimately make things very unstable and so forth. Okay.
And a particular group we refer to, we call the CIIs. That stands for Climate Interested Investors. And climate interested investors are asset managers or other investors who appear through some public position, membership of some type of organisation, to be interested in these longer term issues. And we find there's quite a range of interests within these CIIs. So that's the main acronym we use, and the other one that sometimes gets mentioned is ESG.
Which is Environment and Social Governance, which is really becomes a catch-all for having some interest and responsibility in terms of climate change and carbon emission controls and so forth.
So we hope you enjoy it, because Jeb Sprague, who's made this recording, he only started the record button partway into our talk, and we're hoping that roughly where we finish here brings you into somewhere remotely sensible for the rest of the recording.
So we're trying to unpick what finance capital, as Bill Robinson would say, is really the most fundamental elements of the transnational capitalist class, which is the finance sector. We try to unpick. They're not like Marx says, this is a war, this is a band of warring brothers. It's not actually a homogenous mix, it's actually a series of diverse interests involved here. So what would finance capital be interested in climate change? What would it, and if it is, what sort of interests are there? Long-term costs of failing to deal with global emissions. Are they interested in exaggerated costs to their growth? Or is it also creates investment opportunities? Does the whole thing about the climate crisis create more investment opportunities? But the logic of finance capital seems increasingly short-term. And this is a quote that we've got from one of the people we interviewed. And this person said, depending on the type of investor, typical holdings can be in weeks rather than years. And from their personal point of view, such short-termism is the biggest problem with the existing system. The only thing that matters is the next quarter's results, and that potentially is going to lead to our doom. It's such a short-sighted state of affairs for a global system to operate on. It can't continue because it will lead to such problems. Okay, so this is the methodology that we used to do this piece of research. We did 7 interviews with 10 top players in climate. They're actually in climate finance. 5 from the major asset companies, AMSs, 2 European, 2 of these were European, and 3 were North American. Because we were in Montreal for a while, so we did some research from there. 5 were from climate finance NGOs, and interviewees were 3 out of 5 males in each group. This was supplemented from our finance and climate database, which comprised 30,840 linked records on world's 283 largest target companies from the Bureau van Dijk and the Carbon Disclosure Project. So we're trying to get qualitative and quantitative basis covered. And what a target company is one of the top 250 companies from either 2006 or 2007, and they're non-financial. And the other, the Carbon Disclosure Project that we interviewed was identifying carbon disclosure members amongst targets and CDP investors, signatories of investor members, and the other investor climate institutions were the Global Investor Statement on Climate Change, the UN Principles for Responsible Investment, PRI, and the Institutional Investor Group on Climate Change. Have you people heard of these groups?
Oh, yeah.
You've heard of them, yeah. Okay, so they're not well known, but they're incredibly articulate and very dynamic groups of primarily young people. Okay, so what we've got then is we've got, when we're looking at these factions that we're looking at in terms of this project, we're looking at the target companies, which again I said are the non-financials. They're the top 250 from those two sets of years, 2006 to 7 and 2018. So those are we've got at the bottom, we've got the target companies, and then we've got the asset managers which control these non-financial target companies, and then we've got, within this section of capital, we've got the retail investors, and we've got the institutional investors, and they are primarily like the pension funds, for instance. And they operate very differently, as you'll see. The individual shareholders are also they're a subset of the retail investors. So you've got the individual, the rich people, the really rich, they're part of the retail investors, and you've got the workers' retirement funds leading into the pension funds. So you can see that that's really the breakdown of what we're looking at. So how common are these CIOs? I'll leave it to you, David.
Oh, okay. So this is information from that database of records we've got of ownership of the top 283 companies in the world, and so we can look at the owners of these companies, and we look at the companies themselves. So, looking at the shareholdings of those top 283 companies, we find that 33% of the value of those shareholdings are owned by investors who have signed up to CDP, to the Carbon Disclosure Project, which is probably the most important of the NGOs operating, seeking to influence the finance sector and behaviour by target companies. There's different levels of involvement. This is one of the things that really comes out is different levels of involvement. So 33% of basically of shareholders are signatories to CDP. Only 10% are what you call investor members. They're the more active ones. They take a stronger role. All up, we counted 37%, not 33, a slightly bigger number, 37% of all investors were in some way we decided they were CIIs, because either they were part of CDP or part of one of those other groups that you saw, the PRI, the IIGCC and so on. So we basically took a fairly broad definition of CIIs. We also found that out of our target companies, 73% of them, that's 73% of the top 283 in the world by value, were themselves participating one way or another in CDP. So they had been influenced to take part in CDP. It's partly through lobbying by CDP itself, partly through lobbying by the investors. That's not a big part of the time that we'll spend on, but just to give you an idea of the relative importance of these things. So don't worry about the red and the blue so much, but all up 37% of shareholdings were in companies that were owned by investors that were in some way one of these CIIs, a carbon interested investor, of which the easiest way to get categorised as that was being an investor signatory to PRI. But there's these other things, International Investor Group on Climate Change, CDP Investor I just showed you, The Global Investor Statement on Climate Change, it's something that was signed a couple of years ago, and the UN Principles on Responsible Investment, which encompass not just environmental but also social and governance issues as well. So that's a bit of a broader group. What explains the CIO motivation? So from now on, most of the time we're talking about the outcomes of our interviews, which were split between the investors themselves, the 5 big investors, and they ranged from the really active ones to sort of quite inactive ones, still active enough to be in the CIO category from our point of view. They signed up to one of these things at least, but they picked up a bit of a range. Now when looking at the motivations of these people, one thing that's important to understand is the importance of quantification. And as one of the North American asset managers said, well, everything's basically about money. It's all about financial. It's not about biodiversity or ecosystem, stuff like that. If you can't quantify it, then how can you really account for it in a way that's consistent and makes sense? So, why would a lot of these people bother when so much of this stuff can't be counted? So what are the explanations as to why CIOs why they become CIOs? Well, this is from one of the North Americans, and basically find the North Americans are less active than the Europeans. And one of the things is reputation. Now here in this particular North American bank, they're basically talking about reputation, the importance of managing reputation. That if they invest in something that's potentially damaging for their brand value, then that could cause big problems to them. So they actually have committees and senior people and so on that get involved in conversation. There's a potentially contentious investment, and if they think it's going to be too contentious, well, reputation means we won't get into that. So that's one aspect of it, at the weaker end of it. And there's also what I just mentioned a second ago, the European-North American difference. And they talk about it in terms of culture. Another way of thinking about it is in terms of the Soskis and Hall varieties of capitalism approach, which I won't go into here, but this person here is from one of the European asset managers, says, it's the psyche, I think, in Europe. You hear it more in the regulatory system. And even within Europe, there's, as there is within the varieties of capitalism literature, a big difference between the continent and the UK. UK is much more like the US. And so here they're talking about how the Poms are much more hard-nosed financial than the Dutch, much more open-minded about the kinds of information that might prove to be financially relevant. So they're basically defining a wider range of issues as being financially relevant than are the British and Americans. The big thing is the retail versus institutional thing. And this works in quite interesting and complex ways. So on the one hand, you've got the constituencies of these two groups. The retail investors are basically just individual shareholders acting on their own, and they can, so what some of these asset managers do is they set up particular funds to target towards particular types of retail shareholders, of individual shareholders. And they'll set up a green fund and so on. Some of the really big funds like BlackRock, the biggest fund manager in the world, they'll have, and they're one of the mobs that have signed up for these things. They've got 5%, only 5% of their stuff in ESG, well, climate-related things, but they still consider themselves very, very climate-related. Whereas the pension funds, institutional investors, who take the view, where we got trustees, we can't afford to be missing out on our fiduciary duties of directors. We have to get these rates of returns. So the institutional investors, the pension funds are saying we've got to get this bottom line, where there's more flexibility with the retail investors to potentially choose one way or the other. So the retail investors, in a sense, have got more agency. So this is just to remind you of who we're talking about here, the retail investors, institutional investors. So these guys have got more ability to make individual choices, so to speak. But then there's the contrary trend, the long term. The pension funds are looking at, they're not really, when you think about it, they've got to fund pensions 15, 25, 35 years down the track. They've got to look long term. And they've got to look long term more so than your retail investors. And out of the institutional investors, obviously the pension funds are ones who've got to focus most on the long term. And so here we've got a discussion about a Dutch long pension fund looking at all these long-term criteria and doing it much more so than the British. So the conflict between institutional and retail investors, it works both ways. That basically the pension funds have got to get long-term funds because, and that's going to be increasingly a factor in this debate about the move away from short-termism. So you're seeing these splits in finance capital between long-term and short-term. It follows partly structural lines, but there's also choices made by individual organisations. So the structural position alone doesn't explain whether or not you're a CII. You then get, within investors, what they refer to as disconnects. This North American asset manager says, I go along to these conferences and these investors say that, yeah, they're really interested in climate change, but when they come to it, they don't follow through on it, and therefore the asset managers are unable to follow through as well. And then there's questions of the priorities of different aspects of ESG, because often this issue of climate change is packaged within a broader ESG framework, environmental, social governance. And with the financial crisis in Europe, the other aspects of it, the social governance, have taken precedence over the environmental, particularly with the slowdown of growth in Europe, the collapse almost of the European ETS system. Environmental has not got such a role. There's structural factors within finance capital, insurance companies who have to pay for the damage arising from climate change, from hurricanes and the like. They have to deal with consequences more so than banks and finance companies and so on. So there's those structural issues as well. And there's leadership. There's actual individual agency, individual leadership that makes a huge difference. More so than you might expect. AXA, one of the big European insurance companies, basically established by this guy who's sort of had this great vision about this. And you can actually see that permeating down through the organisation. Trade unions, their roles as trustees on investment funds, they're also relevant. So we get this picture which it's partly structure, it's partly agency. Some of these factors have got more influence, more of a structural element, some of them got more of an agency element. All of them come together to help explain CII behaviour. And then how do CIIs manage climate-related issues? Well, Georgina is going to have apoplexy if I go through talking about how they do it. We can answer questions about that if you'd like us to. So I'll skip through it, except I will say that some of the really activist ones, the European ones that we spoke to in particular, they actually set up really complex systems here. And one of them, big in-house databases that go well beyond what we were able to create ourselves, and even basing their performance bonus system, their performance pay system, around the idea of responsible investment, creating a responsible investment offices. You have to have that in order to get an increase in your base pay, and then you've got performance ratings for achieving certain targets. So, we'll skip all that. Now, the other thing that's important for the conclusion is, okay, so how much coordination do you have between these people? They don't coordinate. So how are they going to act as a class or as a subclass if they don't coordinate? Well, in effect, they're looking to regulation, in the sense that you ask them, what's going to make a difference? Well, we don't want to be regulated, but regulation's what's going to solve the problem. And that's more or less what they're saying. We're heavily regulated. Well, we don't advocate more regulation, but that would solve the problem. And there's others who are, that was sort of somebody at the less activist end. At the more activist end, they say to us, you need a carbon price over $100 a tonne to make this stuff work. So there's a new landscape arising financialisation. You can be happy to. This is the last slide. And there's basically a struggle for power going on within finance capital between the short term and the long term. And there's big forces pushing in both directions. The whole impetus of financialisation, more and more the short term. The climate crisis, more and more towards the long term. So this breaking up within finance capital, so you can see it within the funds themselves. And CIIs will vary substantially within their enthusiasm for CII focus on that, according to those various factors that we spoke about. Then you have this paradox of regulation, like the finance markets, they have been pushing so hard for deregulation of everything that moved and anything that almost looks like it might one day move in the future. They want to deregulate it. And yet here you're seeing a part of finance capital that's saying, well, if we're going to coordinate a response to this, we can't do it ourselves. Regulation, most likely through some form of carbon pricing, be it direct carbon price, emissions trading, whatever, that's the way that it's going to be brought about. So at the moment, you've got, unusually there, and they come together in these forms of collective action, but it's really in action to sort of the NGOs like PRI, CDP and so on. And then unlike in most areas where you see businesses focusing on self-regulation as a means of avoiding regulation, it's actually more of a step towards more effective regulation. In Britain you've seen the introduction of more effective regulation that's been cheered on by the people associated with these groups. So it's an unusual strategy going on within finance capital. At the moment, the short term's still winning, that's pretty obvious, but potentially carbon regulation in finance might be one day a mechanism for increasing the relative power of the long term in this battle. Thank you.